of this reflects a powerful portfolio play, it is also built on strong operational efficiencies, sharp consumer insights, and a sound financial model, combined with judicious and disciplined capital allocation principles. I believe that each of these segments will generate strong, healthy returns for our shareholders while building leading positions in their respective market segments. Despite a proven track record, a world-class management team, robust operating performance over a long time, and consistently strong ROCEs, ABFRL, the market cap of ABFRL does not reflect the inherent strength of the business or the quality of the brands that in many ways are standalone engines of growth. While strangely this becomes even more stark when compared to some of its peers. This investor interaction today has been planned as a comprehensive response to all your inputs, questions, and feedback. Today, ABFRL's leadership team will unpack a broad sweep of topics, from explaining the purpose of the company to articulating the strategic pillars of value creation to sharing deeper insights on our future growth vectors to help you understand the conscious and decisive capital allocation choices that the company is making. The team will also be articulating for the very first time the company's 5-year growth plan. As I now hand over to Ashish and the team to lay out the roadmap for this ongoing transformation journey of the company and of the group to long-term shareholder value creation, I'm sure that you will find today's interaction both insightful and enriching, and I look forward to many more conversations and even more meaningful outcomes. Welcome once again.
Thank you, Mr. Birla. And very good afternoon to all our guests today who are joining from India. A good evening to people joining from Southeast Asia, and a very good morning to analysts and investors joining from Europe and United States. During the course of this next 60 to 75 minutes, we're going to take you through the story of Indian apparel industry, a journey of Aditya Birla fashion, and tell you how we see ourselves in terms of our past and, more importantly, our future. As you know, over a long period of time, ABFRL has been a pioneer in the branded apparel industry in this country. We have built some of the largest and the most loved brands and a portfolio of them. We have acquired and turned around large businesses. You heard Mr. Birla talking about pantaloons. We have entered new segments and created strong positions in new categories as new markets and consumer tastes evolved. And today we have expanded our portfolio with entry into all meaningfully attractive segments of the market as we see the evolving consumer needs. With all this, what we plan to show you is how ABFRL is very uniquely placed in the industry and extremely well poised to deliver long-term growth, profitability, return on capital, and strong cash flows. Starting with the industry itself, apparel industry in India is one of the largest consumption industry at close to $70 billion in 2020 and heading towards $100+ billion in 5 years from now. It is, if not the largest, one of the largest sectors of consumption baskets. What is even more important to note is that still a large part of the industry is unorganized. Close to 2/3 of the industry is still unorganized. Though the rapid growth of organized brick and mortar as well as online is going to create a large shift towards branded players and organized retailers like ABFRL. If you look at in terms of geography also, in terms of total retail spend, the top 24 cities of this country constitute to less than 30% of retail spending, which means nearly 70% lies outside. If you look at apparel market, particularly branded apparel market, these same cities contribute between 40 to 50% of the branded apparel sales, which reflects the amount of headroom that is available for brands to grow. There are other strong reasons why Players like us have strong reason to believe that the branded play will be accelerated in the coming years. The demographic of this country, the well-known young population, rising affluence of the middle class, greater participation of women in workforce, digitization, and most importantly, increase in brand consciousness and rise in aspirational customers is going to drive and create a bigger and accelerated market for us. Specifically coming down to the industry itself, there are three large segments that this industry constitutes. Women's ethnic wear is the largest part of the market, closely followed by the men's formal wear. That's been the situation for the last few years and is likely to be even for next 5 years. Only followed by men's casual wear. And the reason I highlight this is because our presence and a lot of our strategies were guided by the size of the market and its attractiveness as you will go see forward. Let me take you through the vision that we had created, and this was done nearly 6-7 years back as we combined the two businesses to create the Aditya Birla Fashion. We are here to satisfy Indian consumers' need in fashion, style, and value across varying occasions in apparel and accessories. It's important to note that we will do it through strong brands and high-quality consumer experience, both in physical and online retail. This vision has been our guiding principle and in some ways our strategist. And what you will see following through is the strategic choices that we have made coming out of this vision. A quick recap of our journey. Aditya Birla Group acquired a 200 crore business in 1999, which in initial years mirrored the shape of apparel industry in this country and in some ways shaped it by expanding our brands into retail business. The next phase of growth came as we expanded out of the 4 brands and launched new formats both in luxury and value. But the most significant one was in 2013 when we acquired Pantaloons business. Another milestone for the company was 2016 when ABFRL came into being with merger of Madura and Pantaloons business. The last 3 or 4 years have been significant for the portfolio diversification as we studied the market ahead and shifting consumer tastes. These reflected in strong numbers, nearly 19 times in 15 years with a CAGR of 21% over a very long period of time. Similar in terms of Ebitda, growing at CAGR of 19%, again over a long period of horizon. This resilience and quality of this performance and consistency is built around the portfolio of very powerful brands present across the entire spectrum from value to luxury that you can see. Our portfolio also addresses very strong consumer needs in men's formals, women's ethnic, men's casual, innerwear, kids, and practically every other meaningful consumer categories that exist. Built around foundation of very strong brands, which we continue to add as we go forward. Building distribution in India has been a trick that very few companies have mastered. We have nearly 3 decades of quality experience of building very, very profitable and strong distribution. 3,000 outlets, of which 350 large format stores in Pantaloons, present across nearly 25,000 multi-brand outlets and virtually every department store for leading e-commerce players. And let me then come to the point on portfolio. Since it comes up in several conversations, it came up in several interactions that Mr. Birla also referred to. Diversification is a conscious choice which is guided by our vision. We believe, one, India has a very large growth opportunity in this segment, and we would be doing disservice if we don't play in the meaningful segments strongly. Also, in the industry of fashion, there is a constant and rapidly evolving shift in consumer tastes, and it's important that business strategy reflects that. And the reason we believe that we can win in the portfolio play emerges from 5 key points. The first and foremost being our rich legacy of building brands and businesses. Second, our design, product, supply chain, and sourcing excellence that we have built over with professionals over 2.5 decades, something very unique and special to us. Distribution muscle that we've talked about comes with our experience of Indian markets in great detail, but most importantly, the talent that we have been able to attract, build, retain, and grow, and something we are very proud of, which has really been the shoulder on which this business has been built. And continuous investment in what lies in future, whether it's technology or sustainability programs as we speak today. In summary, therefore, our success is built on very strong sustainable pillars of a wide diversified portfolio, rich brands, strong enablers in the key functions of the business, and most importantly, governance, which is driven by Aditya Birla Group system and the values, and finally, and the foremost, the talent which drives all of this. As we look forward, we continue to focus on our long-term value creation engines, and very briefly, I'll take you to two important ones that we are embarking right now. We're executing a comprehensive digital transformation program, both for the front end of our business and inside in the back end of our business. Whether it's driving commerce through e-commerce, omnichannel, or building stronger engagement and affinity for our brands through strong digital marketing, personalization programs, CRM, which is unique and specialization at scale. Equally importantly, we are using technology to drive strong efficiencies and rebuild some of our business models. Whether it's supply chain digitization, go-to-market, which we'll talk about later, use of technology in buying and planning and allocation, which is largely done now by machine, then by men, even in design and markdown management. We are using power of digital technology to make our companies smarter, intelligent, and more efficient. Specifically on e-commerce, we have a three-tiered strategy. One is that of partnership with leading players, and we are the leading partner of every large e-commerce players. This helps us in building wider and relevant assortment, extend brand into new categories, and sometimes even launch pure online sub-brands. We will selectively, and we've started on this journey, build for few of our brands, very strong brand.com, which will be competitive and compelling for customers. And finally, and most distinctively, as a strategic choice, we will build the leading omnichannel play for this industry. As we speak, we already have close to 1,000 stores which are connected through omnichannel play, both in terms of buying online and shipping from store, as well as endless line electronic. We leverage our distinctive advantage of strong brands, large customer base, wide network of stores to actually execute a winning model going forward. We have also been on a sustainability mission for now more than 8 years, nearly 10 years. We started by launching a program called Re-Earth, which exemplifies our commitment to give back to society what we take from the environment. The program sits on wide legs, but covers sustainable products, packaging, green building factories, establishment, work practices, and goes all the way to our supply chain. A program which over a decade has been recognized as the leading one in the country as well as in this part of the world. S&P Global Assessment rated us as Asia's most sustainable company in textiles, apparel, and luxury goods, and 8th best globally. There are several national acknowledgement of the same journey. All this has happened on the back and strength of very strong, committed, experienced, and diverse leadership team that we have built. Most of the leaders that you see here have experience between 25 to 30 years, many of them in this industries and some from outside with great global experience of consumer industries. What you see here is merely the top leadership team. What we are more proud of and extremely confident of is the talent that lies underneath in the middle management and the senior management of the organization, which gives us confidence that as we grow, capital and management will never be a thing that will constrain our growth in any way. With that, I would like to invite Vishak to address and take you through the plans of our lifestyle brands, which in many ways have been the bread and butter of this company for a long, long period of time. Over to you, Vishak.
Thank you, Ashish. As somebody who joined this business as a management trainee 25 years back, it is my pleasure and privilege to take you through the story of Madura and the story of the lifestyle brands that are part of Madura. This story is a story of ever-growing, versatile brands with very, very powerful brand equity, very, very well connected with consumers. What's happening in the market, we are very, very clued in on in both cities, small towns, across regions, consumers, segments, usage occasions. I also want to talk to you about the kind of distribution model that we've created, which is both scalable and asset light, and with lots of headroom for growth. I will take you through the economic model that we've built, which has delivered a consistent return on capital employed over years and is projected for very aggressive growth in the years ahead. And finally, I will also take you through some of the unique competitive advantages which are part and parcel of the Madura way of doing things. First, the brands. And for those of you who are familiar with the Indian market, of course, you know these brands. You've worn them, you've seen people wearing them, you've been proud of them. But for those who are not familiar enough with the Indian market, I'll also talk to you about some of these brands and what they mean to consumers and how they pan across various segments in the market. So first, let's talk about Louis Philippe. And Louis Philippe is symbolized by the crest which is a symbol of excellence. It's a logo which is amongst the most recognizable symbols in the fashion industry in this country. It's a logo which it stands for perfection, stands for the kind of stuff that Louis Philippe has been doing. It's a brand which rates the highest on quality scores consistently, as evidenced in our net promoter scores that we measure from customers. It's a brand where consumers love wearing it. Actually, I would also say love flaunting the brand. So on Louis Philippe, we've been an extremely strong brand of formals. Some of the iconic lines like Perma Press, Gods and Kings, Athwork are part and parcel of that business. We also have a very strong casual line, a sports denim line, sports line, denim line, and in recent times, athleisure and active as well. So you can see that the brand has been able to very successfully spread across different consumer segments which are relevant in the marketplace. There's Alan Solly, which is the original Friday dressing brand, which to us is our driver of smart casuals for the market. We have a very, very exciting range here as well of casuals, of denims, of sport, and recently introduced Work, which is quirky office wear. We've also gone into Tribe, which is youth lifestyle. With all of this, of course, it's a predominantly casual brand. 95% of its business is casual, but we do have a very strong, small formal portfolio as well. It's a brand which is symbolized by the stag. Again, a very, very playful, unconventional symbol, which is very, very well recognized in the marketplace. This is a brand which also pans across men, women, and kids. And as we've grown in the portfolio, we've also managed to create a very, very strong franchise with the women's and kids businesses as well. Then we have Van Heusen, which is amongst the world's largest shirt makers. It's a brand which has stood over decades for various innovations, right from the invention of the collar to various other product innovations that have ruled the men's apparel business. Van Heusen in India is symbolized by the power mark. It's the brand which has worked hard to make professionals fashionable. It's a brand which is the market leader in formals, in party and ceremony. In fact, VDOT is the line which cuts through party and ceremony. It's also the market leader in the suits business, ceremonial business. We have in recent times also extended to Flex, which is activewear. So as you can see here again, you have a very, very complete portfolio of very, very innovative products driving form and function. It's a brand again which spreads across men's and women's. We have Peter England, which is, by the way, India's largest shirt volume brand. which was launched as the Honest Shirt, and it's international quality at honest to goodness prices as our promise. We've worked hard to bring alive authenticity and trust in our relationships. It's a brand which has also pioneered some of the work in small town India, and the kind of connect that we've been able to build with consumers in urban India, we've been able to create a similar success story in small town India, and perhaps also enjoys the largest EBO exclusive brand network in the country. I also want to take you through some of the things that we have done to stay constantly evolving with consumer trends. So as you can see, if you were to look at financial year 10, we were a predominantly formal business, with 2/3 of our business coming from formal wear. We saw it right then that there is going to be a significant change in the way this country works, and there is going to be disproportionate growth in casual wear. We were able to leverage that growth with sub-brands in each of our house of brands, and we were able to grow the casual business disproportionately, even as we continued to grow the formal business. With FY20, we were at 59% casuals, and in recent times with COVID, we've only been able to accelerate that further, and we've further strengthened our casual portfolio. I also want to tell you that even the formals that we sell today is what you would call new formals or new expressions of formals, whether it is with more modern expressions of formals, more multi-utility formals, wedding formals. So we've also constantly kept pace with the kind of aspirations of India and created a line for them which meets that. I want to talk to you now about our distribution and how we've created an asset-light model which is very, very scalable and has lots of room for growth. So if you look at our expansion, you would see that we've been very, very aggressively expanding. In fact, in the last few years, if you take away the COVID period, we've been almost putting up a store a day, aggressively expanding, primarily expanding through franchise partners. So only 435 out of our 2,385 stores are with company capex. We have had the privilege of working with some outstanding franchisees, and we have built a network of franchisees who not only put capital and create great stores, but also bring local insights, great spirit of entrepreneurship into the business, which allows us to keep scaling further. We've also added further ammunition to our EBO network by making more and more stores omni-channel enabled. As we speak, we are 800 plus stores live with omni-channel. This chart will tell you how there is lots and lots of headroom for growth in the markets that in the Indian market that we are in. For example, to give you a sense, we have mapped out every pin code in the country to be able to figure out what formats and what retail stores will we be able to put up in each of these pin codes. We have further then identified for the next 5 years the potential markets that we have. To give you an example, Louis Philippe, which has currently 407 stores, we have identified 500 new markets for expansion. So we could almost more than double the Louis Philippe network over the next 5 years. Likewise, if you look at a brand like Peter England, from 1,014 stores currently over 450 towns, we see the potential to add another 2,000 stores to the network. Another exciting last couple of years in tapping the Bharat opportunity, and this was Peter England Red. When we saw that small town India was growing with lots and lots of aspirations, extremely well connected to whatever was happening in big cities, Peter England went into an exclusive format for tier 4, tier 5 towns. This was an asset-light model, 100% franchisee-led, with the store being of a very high service standard, a complete assortment, but extremely high value fashion at $9.99. The anchor price point at $9.99 was able to deliver immense value to consumers. One of the secret sauce here was merchandise customized for local needs. As you know, small town India is not one India. There are many, many Indias here, and each market has its own unique needs. Of course, starting with a near 100% casual wear as the need to the kind of merchandise that one needs to create for different festivals and local occasions. So we built a line which was customized for local needs in each and every state, and sometimes even within a state, different unique customized assortments in clusters within the state. The network was fostered using local entrepreneurship, which was brought in by our franchisees and their store teams. We've been able to go very, very hyper-local on marketing and merchandising. We've already put up 300 stores in this format across multiple states, gone deep into each state. The franchisees have made good financial returns with the payback within 3 years. So from the 300 stores that we have, over the next 3 years, we see ourselves expanding to 1,000 stores with a network of about 900 crores for Peter England Red. Encouraged by the response of Peter England Red, we then scaled it further with another brand, with Alan Solly, with a format called Alan Solly Prime. Now, this is something which has happened over the last few months, and we've been able to put up 7 pilot stores in Andhra and Tamil Nadu, which have been able to create one more growth opportunity for the business, which is small town India for Alan Solly. Again, we've gone deep into each state. For instance, we launched only in Tamil Nadu and Andhra, and now we are signing up only in these 2 states. We've created, of course, it's a higher priced product vis-a-vis Peter England, and yet we've found that with this strong, powerful, aspirational brand, with a great price value equation, we've been able to provide for consumers something which they love, as evidenced by the pilot stores resulting in an average SSPD of 50 plus, something which very few brands do even in big cities. Again, the merchandise strategy, the secret sauce has been in terms of the kind of consumer insights and the local assortments that we've been able to build. Our teams have worked very, very closely in these markets and have built consumer insights, which help us to create very, very relevant merchandise. The franchising model, again, the financial model is a low discount model with active merchandising, which basically only reduces prices on styles which are not selling well. I will now take you through a very strong economic model that we've been able to build on the business. If you look at our financials, we have grown steadily at double digit over years. We have had a profitable Ebitda track record, and we see a lot of room ahead to be able to keep growing at double digits. In fact, if you take away the COVID period, our growth would be more around 14+% CAGR over the next few years, with again a healthy EBITDA of 11-12% and a return on capital employed which is 50+%, very, very consistently over a very long period of time. In fact, it's been a decade plus that you would have seen very, very healthy return on capital employed in this business. And this business has been generating cash. It's been generating 300 plus crores over the last few years. And so here is a business which generates cash and also still has a lot of room for growth and is able to scale up, and we see plans to be able to scale up over years ahead. To talk you through some of our competitive advantages, why we are able to scale up like this, I think one of our biggest is the 12-season model. We were pioneers again in this, to be able to move to cutting-edge technology, to be able to reduce dramatically cycle times, which, as you know, in the fashion business is in measured usually in seasons. 7 months used to be our own cycle time, now cut down to 45 days. We use state-of-the-art technology to create merchandise digitally, which basically means between our mills, our factories, our designers, our product managers, the entire chain is digital. We create digitally, and hence it really makes it faster. And of course, we are also able to book with our channel partners digitally, especially during COVID. This was a real boon where we were able to, even when physically we were not able to reach our partners, we were able to book digitally with them. And of course, now it helps us not only to reach with them, but to be able to create huge amount of freshness and new designs every month. Also helps us to work very closely with our mills to be able to create rapid responses in line with consumer feedback. I also want to talk to you about our dedicated factory network. We have 10 strong factories, which again allow us very high flexibility to be able to address consumer needs in the market really, really fast. I have stated some of the advantages of the 12-season model. A few more. It helps us to respond really fast. It helps us to customize. Of course, it helps us to improve inventory turns, helps us to work better with our sourcing partners, respond very quickly to consumer feedback, and of course, allows us to connect digitally with our channel partners. Digital is another strong competitive advantage for the Madura business. We've been able to already enable 800 plus stores as buy online, ship from store enabled. And in these stores, we have put very high standards for ourselves on how we measure ourselves on customer service. So the to delivery, which means from the time you receive the order to dispatch, is 6 hours. We've also measured various consumer experience touch points and continuously work to make it better. We've also moved to a much more intelligent machine way of making assortments, of being able to create what is right for the market. And we have a replenishment system, an automatic replenishment system, which makes sure that anything which needs to be replenished, and if a store has sold an item today, by midnight tonight, that item would be on a picking slip in our warehouse, and by 9 in the morning, it would be packed and transported by 2 in the afternoon. So it's a real-time process by which we do speedy replenishments. We've also been able to, with technology, light up our entire inventory to our digital customers and being able to create a truly omni-channel experience. We've also added one more strength to this experience with a hyper-local experience, whereby we light up for individual catchments. We light up respective stores in that catchment. For example, in Peter England Red, let's say in a town like Dindigul, the Dindigul customer would be able to see that store's inventory, and we would deliver within 4 hours to the customer. So to summarize the Madura lifestyle brands winning model, these are strong and versatile brands. We've got an asset-light, scalable, profitable model, a financial model which allows for healthy growth, good cash flows, and return on capital employed, a versatile business which has leadership across multiple product categories, and of course, very strong internal capabilities in channel management, in product creation, in retailing across the value chain. So that's it from me, and I would now invite the CEO of Pantaloons, Sangeeta, to take this forward.
Thank you, Vishak. Hello, everyone. Over the next few minutes, it would be my privilege to present to you the remarkable story of the largest brand in the ABFRL portfolio, Pantaloons. This includes the strategy and actions that got us to where we are and our plans to accelerate our growth while delivering strong returns for our stakeholders. As many of you would know, Pantaloons is a 23-year young brand which offers merchandise for the entire family and was acquired by the Aditya Birla Group in 2013. Post the acquisition, the business faced some headwinds owing to several process and control failures and the absence of a full management team. Consequently, growth in the subsequent years was tepid and profitability remained low. In 2018, our consumer engagement work told us that Pantaloons was recalled by a large number of consumers as a reputed brand with a strong heritage, and it was remembered as a pioneer in fashion and as a brand that brought in large format fashion retail to India. However, the brand hadn't kept pace with the evolving consumer who were seeking freshness in fashion, updated trends, and an enjoyable in-store experience. Therein started our journey to recraft our consumer proposition and to reset our financial model. The turnaround story was pegged on the following pillars. First, revamping our product strategy and store freshness. Second, re-energizing the brand that was seen to be a tad jaded. And third was establishing a sustainable, scalable, and profitable store model. To support this, we tasked ourselves with building a strong organization with a diverse leadership team and infusing new age capabilities, which will allow Pantaloons to continue to win in the future. The results of our efforts over the last 3 years have helped us significantly improve our financials, and with a large opportunity that lies ahead of us in terms of the headroom for growth and profitability, gives us terrific confidence to invest in and scale up this business. So walking you through the first pillar, the relevance perceived value and quality of the merchandise is a key defining factor for an apparel player to succeed. The team at Pantaloons has made significant strides in improving the price-value equation for the consumer over the last 10 quarters and has redefined its private label strategy. On the price-value equation, the key drivers were firstly improving the design aesthetics. The fits and silhouettes of the merchandise were redefined with a far more cleaner look and with relevance for a younger consumer. Our key insight was that the consumer today is very discerning and is willing to pay more for good merchandise, which is on trend and which fits well and flows well on her. But she's not willing to buy a poor-looking garment even at half the price in a sale. The products were improved significantly and the fashion quotient was upped in order to be relevant for a more fashion-aspiring consumer. Secondly, robust and agile planning and supply chain systems are critical to optimizing inventory and to deliver fresh fashion to consumers. From introducing new ranges only twice a season, in the past, Pantaloons consumers now have access to new styles every fortnight. We drop on an average more than 300 new styles every fortnight in our large stores. Revamped supply chain and planning processes have improved both the freshness and availability of relevant merchandise for every store in line with the demand of that particular store. In addition, the delivery time from our warehouse to stores has been reduced from 5 days to 2 days. These initiatives are focused on improving sell-throughs, which is an important metric in the industry. Some early wins that we have seen, the full price sell-through has improved by 10 percentage points between autumn-winter 17 and autumn-winter 19, which means there is 10% less merchandise on discount available for the sale period. We are confident that these initiatives, coupled with further investments in intelligent technology platforms going forward, will improve the inventory turns and gross margins at Pantaloons. Increasing the private label share is a key strategic goal for the organization. A key peg of this strategy has been our endeavor to sharply define and rationalize our private label architecture, to have a clear focus on different consumer needs and occasions, avoiding overlaps. Over the last 3 years, the number of private labels have reduced by 20%, which in turn has facilitated a superior consumer experience and better store efficiencies. To cater to the evolving consumer needs and consumer preferences, we have worked towards building a strong pipeline of new categories and labels. The People brand was integrated into Pantaloons, and the launch of candies in FY20 helped us improve our offering for the young consumers. We have further enhanced our ethnic portfolio by launching saris with a very modern take on this timeless product category. We look forward to launching a premium ethnic label in September 21. As casualization of fashion gains prominence, we are gearing up to launch an athleisure label and a casual menswear label in the next financial year. Expansion from apparel to lifestyle categories is also a key pillar in strengthening our private label portfolio. Home category was launched in February 20, which despite the pandemic has seen an encouraging response. The plan is to strengthen our play in home, in accessories, and beauty and cosmetics. With this plan, we are on course to shifting our private label share from 61% to 75% in FY25. The next few slides are visuals of some of the new launches that I have talked about. Candies and People, the two labels for the younger audience. Saris with a very modern take. And Livingscapes is the label that announced the launch of Pantaloons into the home category. Moving on to our second pillar, which is about re-energizing the brand. There are two parts to this, which is the new positioning and imagery and refreshing the retail identity. The first task for us was redefining the brand itself. With the new working positioning of Style Your Change, all interventions have been focused with building a young, contemporary, and a vibrant brand, which is what the consumers are seeking today. The marketing spends for Pantaloons were doubled in FY 2019, and to target a younger consumer, a large part of the spend was spent on digital marketing. This has helped us to engage with our consumers in a more effective manner, encountering them in their digital journey in a very planned fashion. Our digital campaigns have helped us improve salience and have helped drive traffic to our website as well as footfalls to our store. One of the strongest assets Pantaloons has is its 16 million strong loyalty program base of consumers. Extensive use of analytics and personalization as a platform have helped us harness the power of this customer base. Pantaloons today has the capability of sending bespoke and personalized message based on the past shopping history of its consumer to every single consumer. The second part of the brand was new retail identity. As all of you would know, in fashion retail, the store is the brand. And our teams have worked relentlessly over the last 24 months to roll out a new retail identity. This will help us infuse freshness and vibrancy, as well as improve the overall shopping experience by way of easier store navigation and usage of technology. We've launched 5 stores with the new retail identity, and many more are in the pipeline. This is based on international benchmarks, and to bring it to life for you, here are some more visuals of the new retail identity. Great amount of details on how it is sectioned for navigation, fantastic new fixtures, and interactive trial rooms, and a very modern denim section is what you see on the screen. Moving on to the third leg of our strategy. This was to ensure that our business model is scalable and we establish our store economics to give us the confidence and find the algorithms to plan our distribution footprint appropriately. Over the last few years, Pantaloons has opened 200 stores across different town classes and geographies. As we have improved aspects of our merchandise, supply chain, planning, and brand, we have seen a steady improvement in our store performance. The company-owned and company-run stores today deliver a strong ROCE of 30% and are profitable from year one, and the returns improve significantly as the stores mature. We have honed our store model to make it relevant across various town classes. Metros with a high composition of legacy stores deliver the highest ROC, as you see on the screen, of 34%, while Tier 1 and 2 towns deliver a ROC of 28%. Tier 3 stores largely comprise of younger stores. However, their returns too are very attractive. A very similar healthy ROC is witnessed in stores across sizes and vintage too, thereby establishing a strong store economic model and giving us the confidence to accelerate our expansion plan. With the rising middle class, rapid urbanization, and increasing penetration of internet and social media, we expect demand for fashion to be very strong from smaller towns. While we'll continue to drive penetration in metro and larger cities, Tier 2 and 3 towns remain a key pillar of our expansion strategy. Therefore, we plan to open 250 new stores in the next 3 years across 100 new towns, with large part of the expansion plan in Tier 2, 3, and 4 towns. COVID has accelerated the shift in shopper behavior and shopper journeys, with large number of consumers shifting their purchase to online channels for the first time ever. Fashion, as you would know, is the second largest category in e-commerce. Our online business has grown 3x in FY21 as we have responded with agility to the shifting consumer demand. We expect the online channel to continue to grow rapidly, eventually contributing 8 to 10% of sales versus 1% pre-COVID. We have already made significant strides in turning our stores digital. More than 60% of our network is already Omni-enabled and is driving a large share of our sales on pantaloons.com. We rapidly innovated during the lockdown to launch social commerce, and we are convinced that this channel, which offers great convenience to the shopper, will gain significance going forward. We have plans in place to strengthen our partnered e-com business with omni-channel enablement and strong delivery and service standards. Simultaneously, we are building a new website and a new app to provide a distinctive consumer experience going forward, and having an integrated experience between online and offline is one of the big bets for the future for Pantaloons to succeed. Given that our ambition is huge, it is critical that we build an organization that is fit for future. While there are several initiatives around building strong talent and building a strong culture which have been put in place over the last 2 to 3 years, we are focused on one fundamental objective today, which is the digital transformation at Pantaloons. The digital transformation is planned across the value chain, and it is no longer about building a capability, but the way we look at it, it is a way of doing business. Intelligent systems and platforms to help us design merchandise efficiently with shorter time to market at the back end, to platforms which integrate the online-offline experience for the shoppers, to enabling our talented employees to be digitally enabled, to facilitate collaboration and to drive productivity are all in the works. Data and analytics is a capability we are investing in. With proven store economics, we are confident we have a robust financial model which has improved over the last few years, and we see it trending even further as we start seeing the full impact of our strategy. Pantaloons has accelerated its top line and like-to-like growth over the last few years. In the last 3 years, the top line CAGR is 13%. Strong retail expansion backed by strong L2L growth trajectory has helped us significantly improve the business profitability. The Ebitda margin has improved consistently from 4.9% to 8%. We are confident that with a sound strategy, this growth is only likely to be accelerated. As a result, in the next 5 years, our growth is likely to witness a CAGR of 15 to 16% despite the COVID setback in FY21, leading us to becoming a 8,500 crore organization by FY26 with a further improvement in EBITDA margin to double digit north of 10%. Over the next 5 years, we expect the business to cumulatively deliver almost over 2,100 crore in operating cash flow, enabling us to fund our expansion by investing 1,600 crores back into the business and yet releasing net 500 crores in cash and delivering a high ROC in excess of 40%. Hence, in summary, with the outlined strategy, with the 5 pillars that I have talked about, we are confident about accelerating our growth trajectory and transforming Pantaloons to becoming a strongly loved brand by our consumers with a distinctive and seamless online-offline experience and a highly valued fashion retail brand. Thank you very much. With this, I hand over back to Ashish.
Mr. Dixit, we are not able to hear you. I'm sorry. If you could please unmute.
Yeah. Thank you, Sangeeta, for the presentation. And we now move to some of our currently small and relatively new businesses. We segment these businesses into 4 key categories. The first one is the innerwear, which is now a broader business, which is innerwear, athleisure, and active business. We'll get Puneet to talk to you about both the opportunity, our current success, and our plans. We'll then talk about our 2 brands, which reflect the young India in Forever 21 and American Eagle, which Vishak will take you through. And Vishak will also take you through a small but a beautiful and a resilient and growing portfolio of super premium segment, which includes the Collective and some of the international brands at the super premium end. We'll finally close by taking you through our entire ethnic wear strategy, something that we have taken on recently, and give you a sense of what we see as the potential in that. So let me begin by inviting Puneet to take us through the innerwear journey.
Mr. Malik, you may please proceed.
Yeah. Thank you, Ashish, and hello, everyone. I'll take you through the journey and future plans of the innerwear and athleisure business, the industry disruptor, and the business which is at the cusp of large value creation opportunity. It's a very large, unorganized, and profitable market, which is driven by premiumization and growth of branded segment. In a very short time, Van Heusen has emerged as a clear number 2 player, and the business is built on 5 strategic pillars. a very strong and aspirational brand, a very strong product engine and an innovation culture which allows us to deliver differentiated and innovative products, a multi-channel deep distribution strategy which is supported by an asset-light scalable model, and a very strong category creation engine which allows us winning entries in multiple categories at breakneck speed. The business is now poised for explosive growth and profitability, and we envisage building a 1,500 crore business by FY26 with 15% EBITDA. I'll take you through the market now. It's a large $9 billion market, which is expected to grow at 12 to 13%. Large part of the market is still unorganized and is driven by premiumization and growth of branded segment. Last but not the least, industry structure allows strong profitability. We saw 5 clear opportunities for market entry through Van Heusen. Large unorganized market, strong consumer pull towards aspirational brands, profitable industry structure, most players offering basic undifferentiated products and hence opportunity for innovation, and a strong right to win through Van Heusen's aspirational positioning and natural adjacency. So as we entered the market, in a very short span of time, we have emerged as a clear number 2 player. We launched the business in FY17 and we have scaled it up to 280 crores in a short period of 3 years, from 1,000 multi-brand outlets to 20,000 multi-brand outlets, from 0 exclusive stores to 45 innerwear and athleisure exclusive stores, from about 100 department store doors to 500 doors. We built our business on 5 differentiated pillars, as I explained earlier. So while we were studying this market, we saw that there is strong pull for aspirational brands. Van Heusen is a very powerful and aspirational brand, and over the last few years we have amplified the brand strength through aggressive 360 campaigns across ATL platforms, BTL platforms, and digital platforms. We also saw that the market is flooded with basic products and there is an opportunity to differentiate and innovate. And here we decided to leverage our proven product expertise. We did extensive consumer research, figured out consumer pain points, and launched many innovative and differentiated products. In menswear, few examples are antibacterial innerwear in menswear, womenswear, breathable cup bras, no slip strap bras, and this has created a very strong leadership position for us in the market. We also entered into strategic partnerships with best-in-class manufacturing facilities across the globe, which keep us at the cutting edge of the technology and also keep feeding our innovation pipeline. We've created a 3-layered product architecture which allows us to extend the brand into super premium and premium segments while building our share in the mid-premium segment. Over the next few slides, you will see some of the winning product offerings that we have created in a very short time. So while we had an aspirational brand and a winning product proposition, the next natural thing for us was to look at leveraging our proven distribution expertise to build a deep distribution strategy across channels. In trade, we have entered 22,000 multi-brand outlets in a very short period of time, and we plan to reach about 50,000 outlets over the next 3 years. In retail, we have 3 winning retail formats, and each format can be extended into a very large business. First one is the men's and women's store. Second is the women's exclusive store. And the third one is the active and athleisure store. All these formats can be scaled up through an asset-light franchisee-led model, and we plan to open about 500 stores over the next 4 years. We have leveraged Van Heusen's superior positioning and entered 500 doors across department stores again in a very short time, and we will continue to increase our reach and penetration here and ride on partners' expansion. E-commerce is a channel where we have gained share the fastest. We are clear number one in few categories, and we are again a clear number two in few others. And we are confident of building a leadership position across platforms in a very short period of time. With this, we have a multi-channel, asset-light, deep distribution engine in place. So while we were building this distribution, we also saw opportunity to extend the brand into multiple adjacent categories, which could ride on the same distribution network. So we decided to leverage the strong legacy and heritage of product creation ability and innovation ability of our company. And we have entered into multiple categories after launch of men's innerwear in FY17 in a very short time. In order to further build on the brand traction, create a comprehensive offering, and increase our strength in the market, we entered the women's segment in FY19, again with women's innerwear, and extended that to multiple adjacent categories in a very, very short time. In every single category, we have created winning product propositions, and which has given us a strong leadership position across these categories, and also has opened our opportunity to grow by many folds. So this was our journey so far. Again, to summarize, the business is built on a very strong aspirational brand. It is backed by a very strong product engine and innovation culture, which delivers cutting-edge, differentiated, and innovative products. It is supported by a multi-channel deep distribution strategy, which is again supported by an asset-light scalable model. And it is backed by a very strong category creation engine, which allows us winning entries in multiple categories at breakneck speed. So with this will allow us a very strong position in the market, which will lead us to build a business of about 1,500 crores by FY26, growing from a base of about 280 crores in a short period of time. And also allow us to deliver outstanding financial performance, a business which will deliver about 1,500 crores with 15% Ebitda and about 50% ROC. We would need a cash infusion of about 100 to 150 crores to achieve this scale. But not to miss the key highlights, the business is reaching critical mass. It's highly scalable. It's a low capex model. It's a high ROC business, and the business is expected to break even in FY23. Last but not the least, there is strong headroom to grow even further. Thank you very much. With this, I would hand over to Vishak to take you through the global brands and youth fashion business.
Thank you, Puneet. Let me take you through first the youth fashion brands. I'm sure all of us are very, very familiar with Forever 21, an iconic global youth brand, which has been very, very powerful across the corners of the world. It's a brand which went through a troubled period globally, and it affected our own business here as well for some period of time. Happy to tell you that things after that challenging phase have improved, and we've now got a very good equation with a new parent company, and we've been able to create an understanding with this parent company, which makes it a very competitive royalty, a long-term agreement, and 100% ability to produce locally. So with all of this, we can see now a very powerful business for young fashion, for young women and men across malls and high streets across the country. It's a business which hence is very, very scalable. It's in a value segment, a segment which we understand very well. It's in markets which again we understand well, with very strong relationships with mall developers and landlords. We should be able to scale this strongly. It's a business which should turn Ebitda positive next year itself, and is expected to be a positive EBIT and cash flow the year after. We should make, in fact, the cumulative free cash flow required is going to be with just about a positive 10 crores, which means that in years ahead, it's going to generate cash for the business. The hard part on Forever 21 in that sense is done, and we are looking at now a period of scaling up this brand. Moving on to American Eagle, you're aware that this is again an iconic denim brand. It's amongst the top denim brands in the world. It is the largest denim brand in the US. It's got a very powerful symbol of the eagle. It's very sharply positioned, and people swear by this brand. We got this brand and we started small. We piloted, we figured out our sweet spot for this brand. And I think now we are fairly well poised to be able to scale up this brand. We will scale this through a combination of EBOs, department store, shop and shops, as well as through a strong e-commerce presence. So we do hope that at least in the markets that we operate, we can be in the top 3 denim brands in the next 5 years. The business should turn EBITDA positive next year itself and is expected to consume about 10 crores of cash over the next 5 years. Finally, I want to talk you through another very exciting business. Ashish said that this is a very sweet business, which is it's a business whose time has come. We have figured the model, we have figured the right assortment. We have got some of the best brands which work very well. As you know, we have a model called Collective. The Collective is a luxury retail format where some of the best brands are housed. It's a model which is already, even in COVID times, turned EBITDA positive, and hence we are very confident that this is a business which is now very well poised for scale up. It's also the preferred anchor luxury brand for most malls, and we will look at scaling up with malls as we go ahead. We also have a mono brand business with Ted Baker, with Ralph Lauren and Polo Ralph Lauren, with Fred Perry, Hackett. These are again brands which have now created a very nice sweet spot, although it's relatively smaller business, but these are poised to be profitable businesses for the network. So if you look at the cumulative free cash flow that is likely to be required for this business, it's less than 10 crores. So if you add American Eagle, Collective, and Forever 21, we will no longer require any cash. In that sense, it should be self-sufficient between these 3 businesses. The business, in fact, is expected to be a bit positive next year, and for Collective and mono brands should be FY23. Another important thing to see here is the power of collective.in, which is our website for luxury brands. Again, it has scaled up and has tremendous potential to be a unique luxury e-com player. So that's it from me on these international brands and businesses. I now would like to give it back to Ashish to take you through the ethnic wear story.
The ethnic wear business, the latest one in our portfolio. And while all our businesses are exciting, where we stand in the journey of this business, this is truly a very exciting start of a very long journey. We have started with a clear vision to be a leader in this market. And I'll take you through why we believe and how we believe this leadership will be achieved and how attractive would it be for us. Our route, like our parent company's vision, is to be able to win through a portfolio of very strong brands. A quick sense of opportunity. I talked to you about this in the beginning of the presentation. Ethnic wear is nearly 30% of the apparel market, with women's ethnic wear being the single largest segment in the Indian apparel industry today and even 5 years hence. The branded and the organized part of the market is about 3.5 to 4.5 billion out of 20 billion, and that's growing at 15%. One of the interesting and very unique characteristic of ethnic market is the shape of the market. Most consumer categories operate with a pyramidal market with a very narrow and small segment at the top and a large base. The branded ethnic market, because of the nature of the category, operates with nearly a fourth to a third market lying in the luxury and the bridge to luxury segment. As you know, this is dominated by some of the best designers who have built their brands and business over a long period of time, and each one being unique in that sense. The premium market has several established brands built over the last 10 to 20 years. And of course, there's a value market in the mid-market, which is largely dominated by the private brands of department stores and other smaller brands. The reason we are excited to play in this category is not just its current size, but because we deeply believe that this is where the consumers are moving. there is a visible and marked shift in the way ethnic wear category is seen in this country, and it's poised for rapid acceleration from here on. In many ways, ethnic wear represents who we are, and increasingly a more confident Indian is moving towards ethnic wear for important occasions. It helps us connect with the roots, and you see this in society where more and more occasions are getting apt for ethnic wear. Most important of them is really the wedding, which is the biggest consumption, and I would say the capital expenditure item in any human being, particularly in India's. And ethnic wear is all set to gain a large part of these markets. And therefore, we looked at and created a strong, meaningful rationale for ABFRL. We believe that's a sizable and still evolving market, and therefore there's an opportunity to build scale. We have earned the right to win by carefully and diligently learning this category, both in terms of consumer understanding, product and supply chain in pantaloons, where we sell close to 800 crores of ethnic wear. In the long term, we believe there'll be a lower competition in this category with very few sizable players and clearly no international competition. It's a vacant space for any player to have a comprehensive play because existing players play in one category or uniquely positioned only for one category. We believe with the strong legacy of history of building businesses and brands and distribution, it provides a strong platform to build a meaningful play in this category. Accordingly, we have laid down a clear and distinct strategy to win in each of these segments. In luxury, as you have now known, our plan is to invest in established aspirational designers, and I must admit that we have got two of the best that this country has ever produced. In affordable luxury, we want to take that same partnership and extend it through brand extensions and launch thread designers as we go forward. Premium part of the market, we believe, is more apt for an organic play. We have the experience of pantaloons in terms of category and a playbook of Madura in terms of how to scale up a branded business. The value end of the market, however, will continue to be played through pantaloons. This is our portfolio. We started with a partnership with Shantanu and Nikhil, which is a very strong super premium luxury brand in the men's side, which we have extended recently into SNN in the bridge to luxury pret segment with 3 launches in this year and continue and plans to expand rapidly. Our premium foray began with Jaipur in 2019, which is an artisanal brand, and of course our play in values through pantaloons. In last few months, we have expanded our luxury play with adding Sabyasachi and Tarun Tehalyani to our portfolio of designer partnerships, and 3 of them, Shantanu Nikhil, Sabyasachi and Tarun Tehalyani, probably capture the cream of Indian luxury design market. For the premium segment, we plan to launch, and we have recently announced a partnership with Tarun through a separate company in which we will hold 80% stake to launch a men's ethnic wear brand in the premium segment, which is a large and growing market. And for the women's premium side, we will be launching a brand in August, September this year. With these 2, we will be completing what would be a most comprehensive portfolio and some of the strongest brands in this category to build into a large and meaningful business. This is a reflection of our strategy in numbers, starting from scratch in FY19 where we had no business. In next 5 years, we plan to build a 2,000 crore business, which will be profitable, margin ranging from 11 to 15%. We think to build a business of 2,000 crores from here onwards, with all the investments that we've made, will require only about 300 crores in growing this business because of intrinsic profitability that business inherently have. The business to be EBITDA positive as a full business segment and free cash flow positive, EBITDA positive by FY24 and free cash flow positive by FY25. So that's a strong plan for entering a new category, and we believe that there is a leading position to be taken, which we are well equipped to grow into. In summary, if you've heard all our businesses, really at ABFRL level, our strategy comes down to one, grow our core businesses, both lifestyle brands and pantaloons. You've seen through Vishak and Sangeeta's presentation. We have now a very well-tuned, fine operating model. A strong trajectory of growth is visible, and we just need to execute that diligently. We have also enriched our portfolio in line with how the market and consumers are moving and build meaningful presence in innerwear, casual wear, and super premium, and we'll rapidly scale these businesses. Ethnic wear is a standalone new opportunity which we are very excited about, and that would complete our portfolio as far as the business is concerned. All these where to play choices are also backed by a very strong, efficient model, which helps us a right to win through asset-light growth model, strong agility. You saw that in several presentations in design, merchandising, and supply chain, innovation, and product, and fundamentally a very strong financial model with intrinsically high ROC in every business that we enter. We are able to turn that over a period of time into a strong cash generator. We have also taken you through our future-ready investments, which keeps us always ready to move forward through investments in digital technology and sustainability. At this stage, let me now bring in and invite Jagdish to take you through the financial picture over the next 4 to 5 years, our strategy, our goals and targets, and our ambitions across various segments.
Thank you, Ashish. By now, we have explained in detail how well placed ABFRL's portfolio is in this large growing apparel market. Now let me take you through financial numbers arising out of implementation of our various adopted strategies for gestated and gestating businesses. To start with revenue, the revenues from our lifestyle business has grown at a CAGR of 10% between FY17 to FY20, is likely to grow at a rate of 11 to 12%, and is aiming a revenue of rupees 9,000 crore by FY26. Pantaloon business, which has grown at a CAGR of 13% between FY17 to FY20, is expected to grow even faster at a CAGR of 15 to 16%. This business is expected to clock a revenue of rupees 8,500 crore. The new businesses, which consist of innerwear, global brands, ethnic business, have grown at a CAGR of 23% between FY17 to FY20, will grow even at a faster rate of 32%. This segment is likely to clock a revenue of approximately 4,500 crore. The company's revenue, which has grown at a rate of 11% from 6,600 in FY17 to 9,100 crore normalized in FY20, is further poised to grow at a rate of 15%. The company is targeting to have a revenue of rupees 21,000 crore by FY26, with two of our main business lines, lifestyle and pantaloon, will be having revenue more than 9,000 crore each. Now let me walk you through the EBITDA numbers. The EBITDA of the company and each of our business lines are also showing substantial growth. The lifestyle business will see an EBITDA growth of 1.8 times between FY20 to FY26, from rupees 550 crore to 1,000 crore, as opposed to its previous growth of 1.3 times between FY17 to FY20. Pantaloon EBITDA is expected to see a growth of more than 3 times, from rupees 291 crore to 900 crore, versus 2.3 times growth between FY17 to FY20. The new businesses faced losses of rupees 125 crore in FY20 and likely to have a positive EBITDA of 550 crore by FY26. To explain, the FY20 loss does not include rupees 40 crore one-time cost on account of conversion of People brand to Pantaloon label. Thus, the company's overall EBITDA, which grew 1.5 times from rupees 476 crore to 693 crore in FY20, will now grow at 3.4 times to almost 2,300 crore. Now let me elaborate a little more on our new businesses performance. Innerwear business revenue is aiming to grow at a CAGR of 32%, from rupees 280 crore to 1,500 crore. Global brands revenue will achieve a CAGR of 24%, from rupees 370 crore to 1,200 crore. The ethnic business, which we entered in FY20, will achieve a CAGR of 89. It means almost doubling every year, from rupees 50 crore to rupees 2,000 crore by FY26. Thus, all our new businesses will clock in revenue individually of more than rupees 1,200 crore to 2,000 crore in next upcoming 5 years. EBITDA. The size and scale in these businesses lines will help ABFRL to achieve an equally impressive EBITDA performance. The Innovia business EBITDA will grow from negative 48 crore in FY20 to 225 crore. Global brands from a loss of 60 crore to a profit of 100 crore, and the ethnic business is targeting to have 2025 crore EBITDA. Therefore, we can say that the entire new business portfolio, which we have developed over the past few years, will see an exponential growth in revenue and EBITDA. Now let us go through the return on capital employed and capital employed breakdown in each of our business. The operating capital employed excluding goodwill for our lifestyle brand was at rupees 772 crore in FY March 20 will increase to 1500 crore by FY20. Pantaloon will the operating capital employed will increase from 600 crore to rupees 1600 crore, and the new business capital employed will increase from 436 crore to 1700 crore. Thus, the operating capital employed in the business will increase from total of 1900 crore to rupees 4900 crore. However, there is a goodwill component of approximately 2200 crore relating to business acquisition of lifestyle business from Aditya Birla Nuvo 620 crore, acquisition of Pantaloon of rupees 1160 crore, and the brand acquisition Forever 21 and ethnic brands of rupees 400 crore. Our lifestyle business return on capital employed was at 45% in FY20, will now be at 50% by FY26. The Pantaloon ROC will significantly increase or rise from 20% to 40%, and the new business, which has a negative ROC, will see a ROC of 25% in FY26. ABFRL in FY26 will be clocking in a revenue of 21,000 crore, EBITDA of 300 crore, EBITDA margin of 11%, and ROC on operating capital employed at 35%. The consistently improving trajectory of financial performance is testimony to company's focus on profitable growth as reflected by our absolute EBITDA and EBITDA margins. To sum up, ABFRL revenues will rise at a CAGR of 15%, sharp improvement in profitability, which is reflected in the EBITDA margin expansion of 360 basis points. To specifically highlight about the cash generation, company will generate cumulative operating cash flow of rupees 2,000 crore between FY20 to 26. This is after meeting the capex requirement of the company, which will range from 2,000 to 2,500 crore. Post payout of taxes and interest of rupees 752,000 crore, the company will have free cash flow to the firm approximately rupees 1,000 crore. Company will be in a high ROC trajectory, moving from 12% to 35%. And lastly, though the balance sheet has strengthened in FY21 by raising equity of rupees 2,000 crore, but with significant improvement in operating cash flows in next few years, the company will add further strength to its balance sheet. The net debt targeted is to remain in a range, but a max of 1 to 1.5 times of EBITDA of the company. Let me close by saying this: ABFRL has charted out a strong profitable growth journey resulting into significant value creation for its stakeholders. Thanks a lot, and now we open the floor for questions. Over to you, Ashish.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. At this time, you may click on the questions tab appearing on the left of your screens. To ask a question via audio, please click on the audio question button and enter your name and your company name, and click on the receiver icon to connect to ask a question via audio. To ask a text question, please type your questions and click on the submit question box. Your name will be announced when you are promoted in the question queue. You may please address your questions to Mr. Ashish Dikshit and team. Ladies and gentlemen, we will wait for a moment while the queue assembles. The first question is from the line of Tejas Shah from Spark Capital Advisors. Please go ahead.
Hello.
Better,
Mr. Shah, you
yes.
may please go ahead. Your voice is you're audible.
Am I audible? Yeah.
Yes,
Hello.
please proceed, sir. Please proceed.
Yeah. Yeah. Thanks for to the whole team of ABFRL for taking out time for such a detailed presentation and sharing your thoughts and vision for next 5 years. And thanks to Mr. Kumar Mangalam Bella also sharing his time and thoughts on the company. So it's a good initiative. I hope we continue with this. Uh, first question uh, uh, is for Mr. Ashish. Ashish, so we have come a long way from where we started, and then even after listing, the depth and width of portfolio both have changed materially. So, looking at portfolio today, do you believe there is any white space left in the in the portfolio which we need to fill organically or inorganically? And in that point, where do you see value retailing as a proposition within the portfolio currently today?
So, thanks, Tejas. I see both a question and a suggestion in your question. Uh, See, let me first start by saying in Pantaloons, we have probably India's most democratic brand in this country. Its ability to operate in South Bombay as well as in upcountry Uttar Pradesh, Bihar, or interiors of Tamil Nadu and Andhra Pradesh is quite clear and has been established as some of the numbers Sangeeta mentioned to you. We believe a larger opportunity is really in exploiting this wonderful brand, which has now been fine tuned, and a lot of improvements have been done in leveraging that. So, as far as value opportunity is concerned, our go to position is really to leverage Pantaloons as the primary format and versions of it through customized merchandising, value proposition, assortment, etc. Exactly like you heard Vishak talk about how Peter England was able to twin itself into Peter England Red or Alan Solly. Similar is the experiment going around in Pantaloons. So I would say that's our primary play as far as larger market is concerned. It's also in line with our ambition to build Pantaloons into a 10,000 crore plus business. In terms of large white opportunities, clearly our single largest opportunities, if we go back last 5, 7 years, and if you go back to our vision, the two large pieces that we wanted to address over last 10 years, every piece of our action will dictate. We had identified casual wear and women's wear as two large pieces. From 2010 onwards, if you look at all parts of our strategy, with Pantaloons being a new introduction in 2013, has been around casualizing Madura brands, building women's wear portfolio first in the Madura portfolio, then with Forever 21, and subsequently entering the ethnic wear trajectory. With innerwear, ethnic wear, I think we have two very large growth engines possible. At this stage, I don't see a very large white space. I think we are well covered as far as back portfolio is concerned.
Fair enough. This was very helpful. Uh, Second question is for Vishak. Vishak, good to see you after long, after COVID first time. So,
Yes.
Vishak, Vishak, you and Sangeeta both spoke at length about digital initiatives that we have taken within the company and within the divisions also. So, looking at the digital adoption that we have seen in consumers also in last 1 year, where do you see future of physical store expansion, and why is it still very critical element of our strategy, or will it remain a critical element of our strategy?
Hi Tejas, good to hear your voice again. Uh, I think it's a good question, and we need to recognize the following. One, this is a very underpenetrated country where there is so much opportunity for just creation of retail supply to be able to deliver meaningful merchandise and assortments to length and breadth of the country. And I'm not just talking about small town, even in big cities and metros and markets, I think we are an underpenetrated country, and that needs to continue to be able, our effort has to continue to be able to address that. There is a digital adoption, and I think that is something which we should use as a force multiplier. As you as you probably saw, we've already enabled 800 plus stores as omni enabled, and it's good to see that we are able to create actually further traction to these stores. It actually helps to in fact rotate merchandise faster, create a better value proposition for consumer as we go along. So, Tejas, I see this as something which can be a nice positive force multiplier in the way we look at things, with a market opportunity being addressed with physical stores, and then doing what it takes to make those physical stores even stronger with a strong omni-channel presence. Tejas.
Yeah, sure. And Vishak, in our vision for 26, I was just looking at, despite posting, guiding for decent growth, we are still conservative on margins. It seems at 11% only. So, is it that incremental growth is not that operating leverage driven because it is largely FOFO driven, and hence it won't come through, or this reinvestment is required?
I think it's also, yeah, one is there is format expansion. There is also the impetus for growth in all these stages. So, and I think the Madura business has so much of, it's almost as if there is a large opportunity which we need to grab quickly in that sense. So there is perhaps because of that you're seeing a reflection of that, and yet Tejas, we're talking 11 to 12% EBITDA margins.
Sure. Sure. So basically, this model will remain, will require reinvestment and also expansion. Both can be achieved by remaining at around this levels and margin part. Hello.
Yeah, okay. I thought you summarized that for me, Tejas.
Oh no, sorry. Yeah. Okay. Just a couple of questions. Sangeeta just spoke about having pantaloons aspiration also for athleisure or innerwear, if I got it correct in that slide. So just wanted clarification. Will it be in addition to what we are doing in Van Heusen?
Yeah, sure. So, hi Tejas. I'll just first make just one more point on your earlier question on the role of stores. While we've seen a huge shift to digital, I think we will see an equilibrium. And remember that fashion is a category for a lot of consumers is experiential, right? So we do believe that the two will coexist. We will see where the steady state is. However, I think what's important as we look at our digital initiatives is that the role of our stores will have to be defined from stores to store, right? There may be some dark stores, there may be some stores which are there for salience, and there'll be some store, all stores to serve the consumer digitally and with footfalls in the stores physically face to face. So that was just one point I wanted to add, that it's not that the shift to digital, will be so dramatic. There will be a state of equilibrium that we will see in the next year or two. And I think, therefore, expansion of retail continues to be an integral part of our strategy with the state of penetration of this market. Coming to athleisure, this is not just an initiative, it's part of our strategy of improving our private label share. And as and when we see opportunities and white spaces to put up labels from the fold of pantaloons, from the stable of pantaloons, I think we will continue to do that. And athleisure, as we've seen, casualization is a big trend. We already have a label under the name of Agile, and we believe there's an opportunity to really get more to street fashion, and therefore the white space for a second label. Van Heusen, we continue to sell, and that will be another brand that we will continue to sell. Because one of our objectives is to offer different offerings based on our town classes and based on our customers, and therefore we see this as a large emerging category, and hence to improve the private label share, we will have this, but we'll continue to have our existing brand and Van Heusen as well.
Very, very helpful, Sangeeta. Just if I may squeeze in the last one because for Puneet, uh, uh,
So,
across, yeah, yeah, across portfolio, we have played this segment portfolio wise. So in innerwear, we are actually going with single brand. So and we have a lot of strong brands within Madura portfolio. So any plan of actually playing the whole straddle strategy there by launching, let's say, Peter England at mass end, or Louis Philippe at very premium and in innerwear segment also, or we believe Van Heusen is the only vehicle.
No, I think the market is large and it's growing rapidly. But we also want to make sure that we build strong businesses and build scale in every initiative that we have taken before we get into the multiple other opportunities that we have. So I think we are very keen of building scale quickly on this initiative that we have taken, and then look at there's obviously a possibility of looking at other brands as it's a long runway for us to go forward.
Sure. Uh, that's all from my side. This is a very good initiative, and thanks and all the best to the whole team.
Thank you.
Thank you very much. The next question is from the line of Jasdeep Walia from Newmark Capital. Please go ahead.
Hi, sir. Thanks for taking my question. So I want your views on the women's fashion space, separately for women's ethnic and Western fashion. Specifically, your view on growth in these categories. So let's say if the branded apparel industry is growing at X. So as a category, at what rate would women's ethnic fashion and women's Western fashion would grow in the next 5 years, as per your assumptions? And within those two segments, at what rate would ABFRL grow in the next 5 years?
Thanks, Jasdeep. I'll come in here. See, let me first begin by telling you the structure of women's wear market. 75% of that market, if not more, is the ethnic wear market. And if you were to look at, therefore, Western market, it's about 20 odd percent, with other categories, sort of innerwear and other categories taking wear. So first of all, ethnic wear is a very large market. The overall ethnic wear market, because of a large base at the bottom, may grow relatively slower, let's say 10, 11%, but it's a branded ethnic wear where we expect the growth to be about 15%. As you can make out through organic and inorganic means, we have laid out a strategy to build 2,000 crore business in next 5 years, starting from literally scratch. So you could see the growth rate that we have set an ambition for versus the market growth. On the Western women's side, the market is relatively small. As I said, it's about 10 to 15% if you remove the innerwear part. We believe, along with one or two other international brands, we have one of the finest labels, the most desirable brand in Forever 21. We, as Vishak mentioned, we're of course very keen to grow that rapidly, but it was important we get our model right. In last 3 years, that's what we have done. We've actually resized the store, renegotiated the contract, learned the business a lot more. And as you can make out from the presentation that we had made, we expect to grow this 200 crore brand, or today 160 crore brand, into a 500 crore brand in next 4 to 5 years. So in both segments, our growth rate is way ahead of the market, which probably will be growing at about 15, 16%. We have planned to grow our ethnic wear business from 50 to 2,000 crores, and our women's market in Forever 21 from 150, 200 to 500 crores. We also have women's business in Allen Solly and Van Heusen put together, which is another 300 to 400 crores. We are growing rapidly. If you look at our results in last couple of quarters, we have announced growth rates of 30 to 50% in various periods of time. So that is another market that we expect to grow. So if you look ahead 5 years from now, from a company 5 years back, which was largely a menswear company, we'll have close to 1,000, 1,500 crores in the branded business on the women's wear. Let's say 1,000 crore from Forever 20, 500 from Forever 21, and another 7, 800 from Allen Solly and Van Heusen. We are aiming for close to 1,500 of the 2,000 crore ethnic market from the women's wear segment there. And I'm keeping out the pantaloons business, which has a very strong women's proposition.
Got it, sir.
Yeah.
So you seem very optimistic on growth in the women's ethnic wear segment, but the few, the data which we have for few listed and unlisted companies, suggests that, it's been very difficult to grow in this segment. So what have been the challenges in this segment? To me, it seems like the supply chain is too complicated for a large brand to emerge. So what are the challenges in your view, and how are you planning to overcome them?
So, just a fair point. It's hard for me to comment on why others have not been able to grow. We clearly, as you can make out through our ethnic presentation, we have a viewpoint on how this industry is structured. What are the routes taken? First of all, right from day one as we entered, we have a brand portfolio which will be unmatched by any other single player. Every individual brand, be it Sabyasachi, be it Tarun Tehliani, be it Shantanu Nikhil or Jaipur, leave alone the two new brands that we are talking about. First of all, we'll have to build a brand advantage, something we have learned to do over the last 25, 30 years. As I said, the second piece is supply chain, which we have now, I won't say we have mastered it, but we have understood extremely well over the last 5 to 7 years. In Pantaloons, we design, source, and sell a very large part of ethnic wear that anybody sells. So we have deeper understanding. Also, our designer partnerships are bringing more than 2.5 decades of expertise and experience that they have. So we're really starting from competence advantage, we believe. We'll add brand strength, which I talked about, and distribution is something that we have built as an expertise, as you saw across our various businesses. We think these three would be sufficient, and we are uniquely placed to play all three of them.
Got it, sir. Sir, one final question, if I may squeeze the last one. So, in your quarterly results this time in Pantaloon, you gave breakup of sales into women's ethnic wear, western wear, men's fashion. So, what I noticed was that women's category seems to be more impacted, in the last quarter. What's the reason behind that trend, sir, in your opinion? And has this trend? Has this been trend?
I would recommend let's not discuss a quarter performance. I think this call we want to address long-term issues on the industry. Our confidence in the growth of these markets is built around very fundamental consumer shifts that we are seeing around it, and you would agree with that. Sangeeta, if you want to just give a quick response to that, but I would request let's stay on the strategic questions.
Yeah, I think it's a very simple answer. I think Q3 has a lot of festive sales sitting in it. And as lesser people stepped out, I think lesser occasions. So relevance of occasions is something that has gone down with women not stepping out as much as yet. And festive was the other factor. But this is temporary and we think it will come back soon.
Got it, ma'am. Thank you.
Thank you very much. Next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi team. Thanks a lot for the opportunity. First of all, a very detailed presentation on the various businesses. Clearly, we have access to categories that have a stronger growth trajectory. My question was that, in this scenario where, you have actually a lot of things to choose from, I wanted to understand from you, Ashish, how would you go about your capital allocation strategy? What are the metrics that you use? This is, primarily given the relatively divergent requirements for, say, an innerwear space versus a premium luxury space. So, wanted to kind of just get your thoughts on that, Ashish. Okay. Thank you.
Thank you for that question, Avi. I think it's a very critical question that we get asked, and today's presentation was primarily aimed to address that question. So be patient with me. I'll take you through the steps on our capital allocation. The first and foremost, a lifestyle brand business has not needed a capital in the last 15 years, not 1 rupee in any year. It's a free cash flow generator after taking care of all its growth needs, launching new categories, segments, sub-brands, retail formats, and so on and so forth. So our first and foremost point is that our lifestyle business does not require capital. The second, which is Pantaloons, which is from our trajectory, a large business and on a strong growth trajectory. Till FY18, and I would argue maybe till FY19, Pantaloons was at a level of operations where it needed, in early parts, at least from FY13 to FY18, we needed to invest a lot of capital in sprucing up stores and expanding the business. As Sangeeta has laid out, over the next 5 years, and it was also true for FY19 largely, and but for COVID for FY20 as well, Pantaloons will fund its growth even if were to accelerate its expansion plan. If there is an intermediate year in which a little bit of capital is required, that's all that would be there. So first of all, two of our primary business are net free cash flow generating business. The question then comes down to the remaining businesses. Innerwear, I think we have invested close to 300 odd crores at this point of time, between 300 to 50 crores in the last 4 years. Puneet's plan has shown you for taking the business from 300 crores now to 1500 crores. we require additionally between 100 to 150 crore business. So a very small number compared to the overall business. Vishak took you through the international brands portfolio. Forever 21, American Eagle, The Collective, Ralph Lauren, Ted Baker, Hackett, everything. In FY21, these businesses, and I'm talking of a COVID year which we've just gone through, these businesses put together have been nearly cash neutral. Going forward, we strongly believe that by FY23 onwards, this business cumulatively will start generating cash, not a large amount, and therefore, once again, this business doesn't need capital for growth. The final part is our ethnic wear business, which is the one we have invested. A lot of our capital, I would say close to 600 to 700 crores of our capital we have invested in the last 18 months in building a portfolio of some of the strongest assets that exist in this industry. Here onwards, from FY22 onwards, our estimation is to build the business from current level of 50 crores to 2,000 crores. We will need only about 300 to 350 crores. So if you look at Avi, a company of our nature, it is fundamentally not the stage of the business where we have already made the investment. The Innerwear 350 crore investment is behind us. Forever 21 acquisition is behind us, which we have turned around. Pantaloons has completely turned around. It's not a strong cash flow generator now. Our ethnic wear business, all the investments have already been placed, which is why if you see the net summary slide which Jagdish had presented, he's talking about 5,000 crores of cash generation over 5 years, talking about 2,500 or 3,000 to be invested in the capex, which each of the businesses have factored in, and I'm telling you cash flow after capex. And therefore, capital allocation to that extent is not that large a question in front of us. We are clearly committed to growing each one of these businesses. I think the ambition that we have laid out, you heard Chairman talk about the large play that exists in this country, in this market, our right to be a significantly large player, our operating model, our focus on return on capital. I don't think this is a question that will disturb any of our existing businesses, and we have the capacity to grow each one of them in a focused and very aggressive manner. But in terms of their own cash requirement, I think it's pretty limited as you look at the size of the company going forward.
Okay, just if I could, just kind of follow up on this. I was actually looking at it also from another lens that, this pandemic probably has weighed disproportionately on smaller competing brands in our space. I wanted to kind of just understand, would you be, because we have a very good history of turning around brands, whether it's Pantaloons, whether, now with Forever 21. So how would you kind of look at that opportunity, or would you kind of look at, because you highlighted inorganic / partnership only in the premium end. Would you consider it even for the other subcategories, or that's not something that you are kind of factoring in right now?
Okay, Navi, I would address this question with the lens of history behind us. Look at every single acquisition of ours. Be it Pantaloons in 2013, which was our first acquisition, we entered into a space where we did not have a presence. So it was a vehicle that we picked up and we have built on it. In the last 3-4 years, we have improved it. Forever 21 was an attempt to enter young, fast fashion women's category. Again, a portfolio that we did not have. Our Van Heusen and Allen Solly are targeting 24, 25-year-old women at work. Forever 21 is talking about young teenager and addresses girls from 14 to 25 to 21 year as their primary segment. You look at our latest acquisitions, Jaipur, Shantanu Nikhil, Sabyasachi, and this investment, Tarun Tailiani. Every one of them is marked by the fact that we did not have anything close to it ourselves in our portfolio, and these are meaningfully large opportunity based on very large shifts. If Pantaloons was shift from unorganized to organized and therefore large value segment, Forever 21 was shift towards young Western wear, coming to girls coming into Western clothing, and which is a trend which will grow over the next 10, 15, 20 years. Our ethnic wear play is built around, as I mentioned, the large cultural and taste shift that is happening as more and more Indians are growing fondness and respect for the ethnic wear. So our acquisitions have been strategic, they have a long-term perspective, and they fulfill very large strategic gaps in the portfolio. It's not to suggest that we will never do another acquisition. I think 5 years is a long time. We look at opportunities, but every one of our play will be driven by a long-term strategy, need for a large play in some segment which we think is important or is evolving, and cannot be addressed by our own play. For example, men's casual wear. You saw Vishak's presentation. It is an opportunity that we have conquered with our own brand extensions. Innerwear is a category where we had no experience, but we had the belief that one of our brands could be extended. We needed to learn the product. And you saw Puneet's presentation, we have done it. So we will mix very, very judiciously the organic and the inorganic. At this point of time, our belief is the premium ethnic wear is a market that we will be able to do ourselves. And we have taken small help from Tarun with a partnership with him. And on the women's side, we are going alone as far as that part of the market is concerned.
Okay. Okay, perfect. This is very helpful, Ashish. Thank you very much. Thanks for this.
Thank you very much. The next question is from Richard Liu from JM Financial. Please go ahead.
Hi, thank you for taking my question. Just want to confirm, can you all hear me?
Yes, Richard, we can hear you.
Yeah, hi, Ashish. No, thank you for the presentation. I have two questions. One on the P&L side and the other one on the balance sheet side. The first one is with regards to Madura margin, the lifestyle margin that you all presented for FY26. I'm a little intrigued both from an absolute and a relative sense. From the point of view of the fact that you are actually projecting about 11.1% EBITDA margin for Madura Lifestyle in FY26. And I think Madura did about 12.5% in not so recent past. So, given the strength of the brand, given that it will be of a much bigger size, operating leverage, etc., why would you be projecting such a low margin for Madura in FY26? And I also want to juxtapose this against Pantaloons, where you're talking about Pantaloons making about 10.5% margin in the same year. And given the fact that Madura is a brand business, and I always thought brands are much more powerful than labels, and also half of it coming from non-store related network. I would think that over time, Madura would have been a much more profitable business as compared to Pantaloons. So from both from an absolute and a relative sense, can you help me understand this margin that you projected for FY26?
Great, Richard. I expected only tough question from you, so let me try and address this. You're right. I think Madura has historically operated between 11.5 to about 12.5% for some of the recent past. Therefore, to that extent, 11.2% that we are reflecting is perhaps lower than the trajectory that we had for much of the years. At first level, it obviously is a reflection of the conservatism with which we want to sort of commit to our stakeholders with a longer term view. But at another level, it factors in some potential disruption in the industries, the large growth of e-commerce creating some bit of margin squeeze. We believe that large part of our growth will be driven through this variable model, which they just were talking to Vishak about. It's increasingly going to be a retail, so direct to consumer businesses. We also believe that even 5 years later, our brands will be very small. Individual brands will be about 2,500. We have the power to imagine, to believe, and to build 5,000, 8,000 crore brands. If you look at the markets abroad, $1 billion brand is the minimum that Indian markets need to look at it. We would be investing even deeper at that point of time. So what we have factored in, Richard, is not really, in our sense, Madura brands are not in the cash flow these are the stars which will drive growth over the next 15, 20 years. And we need to make sure that we are consistently investing, and as time grows, evolving, changing. And we have kept provision for all that in our long-term orientation, because this is, how many models fail when you just linearly extrapolate things. We have been cautious about doing that. And we want to make sure that we factor in potential disruptions, need to tweak businesses, entry to new categories like women's western, kids wear that we are looking at extending into other categories, potentially a slightly differential value chain if e-commerce becomes a larger part of it, and significantly more investments in both digital and marketing at that point of time. It is possible that we will come back because operating leverage clearly is what you're saying is possible. Some of it is not maybe fully factored in. We'll look at it as we get closer to it. But that's really what our view on Madura side of the business is. On Pantaloons, on the other hand, it's a more fixed cost business. Our stores have operating costs. As we go, there is a leverage at the company level that grows, which covers things like fixed overheads and marketing. Unlike Madura, which is a more franchisee, therefore variable cost model, Pantaloons is largely a fixed cost model. And therefore improvement coming in, the pace at which the GM flows into the Ebitda is much higher in Pantaloons business, both from improvement in product mix, increase in share of private label, and also the operating leverage because the fixed cost nature of the business allows that to travel much faster in Pantaloons business. I wouldn't look at both in comparison to each other, but I think individually, I believe that both of them would be well placed with their peers in the industry, and we'll still be looking to invest and grow at that point of time.
Sure. I'll leave it at that. But just that I was I was under the impression that Madura gross margin is at least 15 percentage point, if not higher than compared to that of Pantaloons. So when you're saying that both the margins converge, I was just wondering, what's going to be the application of this 15 percentage point extra margin cushion. But I heard you in terms of of what you said about FY26. And in the interest of time, I'll probably just move on to my next question on the balance sheet, where you talked about a targeted net debt to EBITDA of about 1 to 1.5 times, and you're going to have an EBITDA of about 2,300 crore in FY26. So are you talking about you still having a net debt of 2,300 crore to 3,500 crore in FY26?
No, Richard, I think that's not the correct interpretation of what Jagdish has said. If you look at our current projections, we had talked about this year ending with 250 crores without the transaction of Sabyasachi and Tarun. If you include all of them, we'll probably be 700 to 800 crores. Over next 5 years, we have indicated a cash generation of 1,000 crores after taking all the investments in new businesses, innerwear, ethnic wear, Pantaloons expansion, and so on and so forth. And therefore, to that extent, if you just look at and translate that number, it amounts to not having any debt on the books. What Jagdish has outlined is that over a longer period of time, which is 5 years, is indeed a long period of time in terms of what could happen in this industry. As we take any other move, we will be guided by a principle that we should not allow our debt to go above 1 and max for a very short period if it has to go 1 to 1.5. So it is almost a learning from past, which we are going to use for ourselves as a guiding principle. Our current business plan does not actually indicate need for debt going forward.
That's a relief, Ashish. Thank you very much, and wish all the best.
Thank you.
Thank you very much. We'll move on to the next question, which is a text question from the line of Aditya Soman from Goldman Sachs. So Mr. Soman has asked 2 questions. The first question is, any sense of what ROI you target at an ABFRL level and the key drivers in achieving that ROI target? What gives you confidence that ABFRL can achieve higher than market ROI in the medium term? The second question is, how do you decide where to expand the network and what demographic or income thresholds help in determining potentials for brand or stores in a new location? Thank you.
So, Aditya, what I would do, I'll get Sangeeta and Vishak to answer the second question first, by which time Jagdish will sort of get his numbers together to answer your response on the ROI. Sangeeta, you want to go in, or Vishak, you want to go in, just address that?
Sure. Sangeeta, you want to go first?
Go ahead, whatever.
Okay.
I can.
Aditya, basically what we do is at a pin code level and then at a town level, we look at the attractiveness of the town in terms of population and in terms of multiple indicators of prosperity index. So, and that goes up to right from occupation of people there, the number of hospitals, schools, dealerships, the other surrogate retailers, and so on. It's a fairly elaborate exercise by which we arrive at an index for every pin code. On that basis, we decide what format of retail to put in that market based on our own past experience of the correlation that we've had with similar scores for the stores that we've already put in. So that's broadly the framework that we use in the Madura business.
And likewise, in case of pantaloons, I think while we have a sense of the level of penetration in the market and a sense of which are the potential cities and what kind of growth is possible, I think just to arrive at that in a quantitative manner, there are various surrogate measures that one uses to assess the market attractiveness, as Vishak said. And having defined that, I think then in case of pantaloons where you see stores from 10,000 square feet ranging up to 55,000 square feet as well, I think we've now got an algorithm to understand that in what kind of town class, what size of store actually works. So establishing the market attractiveness is the first step, and then deciding what's the right format based on the normative data that we have is what we use to decide our course of action on expansion.
Adityan, ROI, for FY20 it was 20%. If you exclude 21, gradually we will ramp up our ROI from 12 to 15, 18, 24. And the improvement is coming primarily because of from the three sources. One, the absolute profitability rising in the company. Number two, tighter working capital. The working capital norms at all the businesses are implemented. And number three is that the new businesses like Innovare and global business, you must have heard from Puneet and Vishak that they will be converted from loss making to the profit making. So all these will add to my profitability.
Aditya, if I can just come in, at a phase in life of the company, depending on how recent our acquisition have been, there are times when our ROI gets affected by at least the goodwill or the initial capital that comes in. I think there are two ways to look at it. One is clearly as a company, we need to manage our overall return on capital, including goodwill in double digits. I would say that's one principle. We were there in FY20, and but for COVID, we would have been 50 odd percent, even with all acquisition built in at that point of time. But I think I would also urge you to look at the individual businesses operating ROCs, which is where we generate returns from the operations of the business through management efforts, because those are the longer term trends that we need to pick on. And all our businesses, whether it's Madura, which is driven by always a perpetual 50% plus ROC business, Pantaloons, which we've turned around from loss making to 25% and heading towards 35 to 40%, or even Innovare, where after deep initial investment we are turning out. So we look at individual businesses to generate cash flow and ROCs. The company level ROEs sometimes get affected by the timing of opportunities or acquisitions that we may have made, but it will be our endeavor to keep it in healthy double digits. I think it's got impacted right now, both with COVID coming in and a year of somewhat difficulty. But we think we'll come back to you. Our projections indicate about 25% plus with all acquisition built in with goodwill at this point of time, 4-5 years from now, and 35 to 40% without goodwill. So those are the numbers that we have currently indicated.